All right, in this next video, we're going to look at how to account for a lump sum purchase, and then we will continue by talking about capital versus revenue expenditures and start our discussion on depreciation. So sometimes a company will buy several kinds of plant assets all at once as one whole purchase. So in that case, if you buy a bunch of things as one whole purchase, each of those items individually need to be put on the books. We wouldn't just lump them all into one. So in this case, assume a company made a purchase for $800,000 here, and that purchase of $800,000 included land improvements, building, and equipment. So when we make this huge purchase of $800,000, the land we purchased, the land improvements, the building, and the equipment we purchased, all of those will have their own account on the books. But first we need to determine how much of that $800,000 we will distribute to each of those. So if you don't know how much of that $800,000 is attributable to each of these on their own, that's when an appraisal will become very useful. So in this case, we would have to have each of these items appraised. So in this case, when they appraised each of these items, they appraised the land at $250, the land improvements at $50, the building at $300, and the equipment at $400. So overall, everything purchased had an appraised value of $1 million. So then the first thing that you do then is determine, okay, what percentage of this total appraised value do each of these assets represent? So for example, the land being valued at $250,000 out of the $1 million, that represents 25% of the total appraised value, and you do the same for each of those. And then using these percentages, you'll multiply each percent then individually by the original purchase price of $800 to determine how much of that $800,000 you will add to each of these asset accounts. So 25% of $800,000 is $200,000. 5% of $800,000 is $40,000, and so on and so forth. And we can see here after we allocate them using those percentages, we get to the $800,000 total here. So once you determine what each of these assets cost is that it was allocated based on the appraised value and the percentage of the total, this is what that journal entry would look like. So now we know, for example, that the land will go on the books at $200. So we would debit the land account for $200,000. We would debit the land improvements account for $40,000. We would debit the building account for $240,000. And lastly, we will debit the equipment account for $320,000. Let's assume this purchase was all in cash, so we're going to just credit cash here for the overall $800,000 of the purchase that we made. So that's what the entry would look like to record that $800,000 lump sum purchase that included a bunch of different assets. So it could be that beforehand you would know, okay, you're paying this much for this item, this much for that item, and just bundling it all together. But if in the event that that information is not known, you would get everything appraised, find out the total, find the percentage that each asset represents of the total appraised total, and use those percentages to figure out how much of the total cost there you will allocate to each asset individually. So that's how we account for a lump sum purchase. Now, what about capital expenditures versus revenue expenditures? So capital expenditures, these kinds of expenditures are recorded in asset accounts. Okay, so these are recorded in asset accounts. So these capital expenditures, it's any material expenditure that's going to benefit several accounting periods. Will benefit several. The key there is several accounting periods. So for example, land improvements. That is the cost associated with improving land is going to benefit several accounting periods. So we would create an asset account for those expenditures instead of just expensing them out. Anytime that any expenditure is incurred that we know we're going to benefit from, not just this period, but several periods to come, would be considered a capital expenditure. So that's why the cost of purchasing a building, of purchasing equipment, of purchasing land, all of those, we don't just call it expense for the period. They're considered capital expenditures, where we create an asset account for those costs, put the costs in that account, and keep it in there. And then we will either depreciate the asset if it's depreciable, or it will just stay there. A revenue expenditure, on the other hand, these are recorded, don't want to write in highlighter. These are recorded in expense accounts instead. Recorded in expense accounts. Okay, so a revenue expenditure, to distinguish it from a capital expenditure, this is a kind of expenditure that is going to benefit only the current period. So if we're talking about repair or maintenance on a building or a piece of equipment, we won't add that to the building or equipment account, but we would just expense it out in the period and call it maintenance expense or repair expense. Now, if you're doing something major to a building and adding improvements onto the building, like adding a whole new section, making the building larger, stuff like that, in that case, it would be argued that it would make more sense to add that to the building account or have a separate account for building improvements. In that case, that would not be considered an expense, but would be considered a capital expenditure that is considered depreciable. But the main difference here between capital and revenue expenditures is that capital expenditures is those costs we incur that are going to benefit us for several accounting periods, so they have to be added into an asset account. And revenue expenditures are recorded in expense accounts because they are only going to benefit us in the current period. And why is it called revenue expenditure? Well, remember, expenses are those things we incur within a period to help us generate revenue within that period. Okay. Well, the important thing here is that revenue expenditures, they're not depreciable because they're not considered assets. They're just expensed out. But some capital expenditures are depreciable, like buildings or equipment or land improvements. So the whole depreciation process, that is where we allocate the cost of a tangible plant asset to expense in the periods where we are going to receive benefit from that asset. So, for example, a building, if we buy a building for $100,000, the $100,000 will stay in the building account, but we will systematically allocate a portion of that $100,000. We'll convert it to expense each period as we're using up that building and receiving benefit from that building. So you start out with the purchase cost when you purchase the asset, and that asset is put on the balance sheet. But then little by little, as each period goes on, as you receive service from that asset or receive benefit from that asset, you're going to convert a portion of its initial cost to expense, specifically called depreciation expense. Now, there are some key terms that we are familiar with, but are very important in this chapter that we want to remind ourselves of. The first being, with regards to depreciation, book value. So remember, book value, it's the initial cost that you recorded on the books for the asset minus its accumulated depreciation. Or in other words, it's the amount of the asset's cost that has not yet been depreciated, the undepreciated amount. The accumulated depreciation, remember, this is a contra asset account, and this represents the portion of the asset that has already been converted or allocated to expense. So this is the portion of the asset's costs converted into expense. So when you look at the accumulated depreciation account for an asset, the total you see there is just the total amount of the asset's cost that has been used up, essentially, or converted to expense. Now, what is a cause of depreciation? So there's two main causes. So the one cause is physical deterioration. That's when something actually gets used up. So think of like a vehicle or a building has normal physical deterioration. But another cause of depreciation just naturally for many items as well is just obsolescence. Something losing its usefulness over time aside from physical deterioration. So especially as technology improves, so if you think of a piece of equipment, as technology gets better, yes, the equipment will deteriorate physically, but also it will become more obsolete as the years go on, as technology gets better and better. So for depreciation purposes, there's a couple of methods that we can choose from. So the one method we've already come across is that of straight line depreciation. So GAAP, so generally accepted accounting principles, it only requires that the method that a company chooses to use is rational, and it provides for a systematic allocation of an asset's cost over its useful life. So the straight line method, which we already learned how to do, at least the really basic form of it. The straight line method, this is the most commonly used depreciation method for financial reporting purposes. So we know that the straight line method, it allocates an equal portion of an asset's cost to depreciation expense each period over that useful life. But there are other methods that we'll look at in this class, and they are accelerated methods. So accelerated versions of the straight line method. And depending on what kind of asset we're looking at, we will also look at depletion, for example, which would specifically relate to natural resources. But this is it for this video. In the next video, we'll look at straight line, and we'll eventually start getting into discussing the different depreciation methods.